Hey friends, welcome back to the channel. On today's video, we'll explore index funds, what they are, how they function, and what are the benefits. So let's begin. Index funds are designed to track the market as a whole or a particular segment of the market. In order to do this, they set up an index which tracks particular securities. As an example, you might have heard of the S&P 500, which is an index set up by Standard & Poor's, the rating agency, and it tracks 500 large US stocks. By investing in the S&P 500, for example, you will end up owning a share of 500 companies in the US. The idea being that over a long period of time, these companies as a whole will give you good returns. From an Australian perspective, you might have come across investments which attract the 200 or the 300 largest companies on the ASX. That is an example of an index fund in Australia. You can have index funds which track the FTSE 100, the CAC, and countless markets in the world. So they are very popular and they're growing day by day. Now with the index funds, what they do is, as they're tracking the market, periodically they will reweight their portfolio based on the latest index as to how the market has moved and buy and sell accordingly to make sure that the investment always tracks the particular index. Benefits? That's a good question. Lower cost. These funds track an index. They do not have a team of analysts sitting, analyzing opportunities, finding best options which they can do for the investors. What they are doing is just tracking an index, periodically, for example, every quarter, reweighting to align back to the market or index, whatever they are following. And in that way, they have very low brokerage cost, they have very low operating cost, and they pass it on to their investors. Number two, well, it's options. You can pretty much invest in anything today you want. You can buy corporate bonds, you can invest in properties, you can invest in lithium stocks, you can invest in electric car companies if that's what you're into. You can invest in resources. You can invest in the 200 largest or 300 largest companies on the ASX. You can invest on the FTSE 100. You can invest on the MSCI indexes, some of which track the whole world. The options that you have with these are unlimited. That's why they are popular, because they allow you to design a portfolio which suits your needs as per your risk appetite. Now, if you're liking the video so far, please consider giving it a thumbs up while we go to point number 3. Now, the third option, and this can be a bit controversial sometimes, is the fact that these funds have a better performance as compared to active funds. What do I mean? Over the years, there are many studies out there which have documented that active funds do not outperform their benchmark. But in the case of index funds, theoretically, they are just trying to align themselves to the benchmark. So they will give you broadly what the market returns are. So that's why these funds have developed a reputation of giving you good returns in the long term. Now, index funds have been growing in popularity over the years. Today, there are trillions of dollars invested in these funds. The fact that they offer low fees and returns as per the benchmark make them an attractive option for a lot of investors who are not looking to trade actively or do not have the time to be managing their portfolios. Now, I hope this made sense. And if you liked the video, once again, please consider giving it a thumbs up. I have another video linked over here which might be of interest. And until next time, bye.